All right, so let's put some of this stuff to use that we learned. So, first of all, what I want you to think about is a couple of key terms here. Okay, so break even. This means we are making zero money. Okay, zero money made. It means that we have just enough revenue to cover all of our costs. Okay, so we made nothing. That isn't the ideal business scenario, though it may be very true for a lot of businesses. Okay, the idea is that we want to make some amount of money, right? So, what's our goal of money to make? Is it 50,000? Is it 10,000? Is it 100? What is it? Okay. Then the idea is we've got a measure of how much sales we can lose before we start losing money or go below break even. Okay, so that's what we're really focused on here. So how are we going to use the information that we just learned? All right, so a couple things that might be familiar to you. So here's our selling price per unit, variable cost per unit, contribution margin per unit. Okay, so we're going to use that as well as the contribution margin ratio that we just calculated. So in this example, our selling price per unit is $520 and our variable cost per unit is $286. That means our contribution margin per unit is $234, right? Because selling price minus variable costs equals contribution margin per unit, okay? But don't forget, we want to express these as a percentage of sales. So sales is 100%, whereas my ratio of contribution margin is 234 divided by 520. Okay, so just so we remember, 234 divided by 520. Okay, so in this case, our contribution margin is 45%, which means our variable cost or variable cost ratio has to be 55%. Okay, so depending upon the information that you have, this is good to know again, this relationship. So calculate break even sales units and sales dollars. I'm going to show you two ways. Now, again, remember what break even is. We can define it a couple different ways. Net income equals zero, contribution margin equals fixed cost. We could also say that our total revenue equals our total cost. Okay, so let's all break even. So when we calculate break-even sales units and we know our contribution margin per unit, makes it fairly straightforward, okay? So how much do we need in contribution margin to cover our fixed cost? Well, we need 163,800. So how do I calculate my break-even units? I take my fixed cost of 163,800 divided by $234 per unit. Now that gives me 700 units. So if I sell 700 units, I can break even. Okay. Well, how do I convert that to sales dollars? Well, first of all, we know that our selling price per unit was $520. So if I take 700 times 520, that's 364,000 of break-even sales. But I want to show you a little trick or a shortcut. What if we don't have all of that? All we need is our contribution margin ratio. So 163,800 divided by 45% or 0.45 will also give us 364,000. The next example here, okay, now I want to talk a little bit about target net income and this idea of margin of safety. Okay, because when presidents and CEOs are talking about results, they're most likely going to be spending a lot of their time focusing and talking about revenue. So when they talk about revenue and they say that, you know, they may make about $1 million of net income. Well, how do they know that if they don't know what all their expenses are? It's all because of this model, this cost volume profit model. Okay, so this is pretty powerful. All right. So with that, we're looking at this Presto Corporation. Okay, sorry, let me get on the right tab here, right screen here. Get back here. Okay, here we are. All right, so Presto Company, total variable cost. Okay, let's just fill that in. Total fixed cost, let's fill that in. Total revenues, let's fill that in. Okay, so what does that give us? Well, sales minus variable cost equals our contribution margin. Notice these are in total. Okay, so our contribution margin is 120,000. Okay, we subtract our fixed cost from that. Our net income in this scenario is 10,000. Now that's not break even, because remember, break even net income would be 0. Okay, so keep that in mind. So if this is our scenario, sales, 100% of sales, can we calculate this the same way? 120,000 of contribution margin in total divided by 300,000 of sales in total gives me a 40% contribution margin ratio. Means my variable costs have to be 60. Okay, so let's calculate break-even sales. Now ask yourself, should these sales be higher or lower than the 300,000? Well, if 300 in sales generated net income of 10,000, our break-even sales will be lower than 300,000. Remember, we're covering fixed costs of 110 divided by 0.4. That should be giving us break-even sales of 275. And again, ask yourself, does that make sense? Yeah, because when we have sales of 300,000, we're making net income. So this is where our margin of safety comes into play. So in dollars, sorry about that, what really is margin of safety? Well, again, the margin of safety just says how much can we lose in sales before we start losing money. Now that'd be a hard question to answer if you didn't have the information above, okay? But here it's pretty straightforward. So if I look at this, in sales, I'm going to take my 300,000, because that was my sales when I'm making 10,000, minus 275. So in dollars, my margin of safety is 25,000. So I could say that, well, as long as I don't drop in sales by 25,000, I'll still make money. Okay. But what about the ratio? The ratio just makes it a little bit easier to understand. Let's say on a scale of 0 to 100%. Okay. If we're 100%, then that's pretty good. We can lose basically 300,000. Okay. But if we only have 25,000 to lose, if I take that 25,000 divided by my original or expected sales, not break even sales, but original or expected, actual or expected, I get 8%. Okay, so that means my sales could drop by 8%, which a lot of investors and analysts will talk about growth in revenue and declines in revenue, and it's all tied to revenue and sales being the same thing. And that's all tied to understanding kind of this cost volume profit analysis. And then in the very last video, or section of this video, this one's a little bit more involved, but as you think about this, I want you to consider what we've already learned and kind of filling in the blanks as we go, okay? So the questions that are being asked is break even. What is our break even sales? Oops, let me put this in here for us. What is my break even sales? Okay, sales dollars. That's what we're looking for here. But what about this idea of target net income? Again, we don't always want to just break even. Okay, again, break even means our net income is 0. But what if we want to generate target net income of 75,000? That means, and here's the key, our contribution margin has to not only cover our fixed cost, but also help us generate 75,000 in net income. Okay, so thinking about this, we know that sales are 100%. Okay, now this tells us for this company variable costs are 70%. Well, if that's the case, that means their contribution margin ratio has to be 30%. Okay. Fixed cost are 195. And management wants to generate net income of 75,000. Okay. Now we can very absolutely back into these. Okay. But let's just use this information that we have to calculate sales, and then we'll kind of check ourselves. So remember, fixed cost divided by contribution margin ratio of 30% would tell us that our break-even sales are 316,667, if I did the math right. Okay. But in order to cover 75,000 of net income, not only do I have to cover my fixed cost, I need to cover that 75,000 I want to make. So really what I'm trying to cover is a total of 270. Again, fixed cost plus 75,000. Take that divided by my same 30%, and that will give me 900,000. Okay. Now, this scenario here already took into account the 75,000 of net income. Okay. So the question is, if I'm working backwards, do I arrive at net income of 75,000 if I have break-even sales dollars of 900,000? Well, let's put it in and see. 900,000 times 70%, 630,000. Okay, 900,000 times 30% is 270,000. Okay, or 900,000 minus 630 equals 270. Okay, if I subtract my 195, I end up with my target net income. Now, these boxes are here. Are we going to use these? No. Okay, we don't use that in our analysis. Okay, just want you to think about that. All right, so now you've got some numbers to work with. You've got some homework to practice some of these concepts. Let me know what questions you have.